You can raise often a faster couple hundred mil fund because a lot of the institutions open up.
So, what are typical fund sizes that are viable and strategic for a fund one in these two markets?
Often institutions are looking at minimum 10 mil and maximum of 10% allocation. And so often in Europe, if you're raising anything less than 100, many institutions aren't within your target LP bucket. And so often if you're raising a few hundred, it's easier than if you're raising 10 or 20.
Welcome, everyone. For those of you who may not know me, my name is Mirto Lalakos. I'm the founder of the Emerging VC. So I spent the last 4 years running the programs that launched around 60% of the world's new VC funds globally. And during that time, I became a top voice on LinkedIn for amplifying content that relates to starting VC firms and scaling VC firms. So between those two things in combination, I became first degree connected to 20 to 25% of the active VC firms worldwide. And I now run the Emerging VC, which is an independent resource for emerging VCs where I curate and I amplify the latest insights and resources on launching and scaling VC funds. The program I used to run that was launching these VC firms is called VC Lab. And it was founded and still headquartered today in Palo Alto, California. And we were accelerating between 50% and 60% of the world's new VC funds worldwide. But because of the nature of the venture capital market, it just so happens that most of these funds being launched were based in the US. And so when talking about VC firms, a lot of the US playbook does apply globally because at the end of the day, venture capital is the same model more or less worldwide. But we kept having managers come to us and say, oh, the program is too US centric, etc. So we're putting that claim to the test today, and we're going to be comparing how a lot of the US based VCs were launching funds to how EU firms are launching firms. And to help me do that, we have the incredible Jonathan Hollis, the founder of Mountside Ventures, with us today. So I'm going to quickly introduce you, Jonathan, but then I'd love it if I could pass it over to you. But for everyone who doesn't know Jonathan, he runs Europe's leading accelerator for emerging VC managers. And Jonathan also spends a lot of time with limited partners and helping connect them to funds in Europe. So Jonathan, welcome. Thank you so much for being here. I'd love to pass it over to you if you could also introduce yourself.
Thank you. And hi, great to be here. Hi everyone. I'm sure there's everyone's dialing in from different parts of the world. I'm in London at the moment in our WeWork by Waterloo, which is one of the largest in WeWork, 16 floors of just co-working. So it gets pretty crazy in the morning and in the evening. And so before launching Mountside, I was at PwC for 10 years, started their corporate accelerator and then fundraising practice for early stage, and then launched Mountside 6 years ago to help and work with founders and funds on their fundraise with a focus on a global LP perspective, a European GP perspective, and a European found perspective. And as mentioned, we launched the first accelerator for funds specifically in Europe a couple of years ago, which was a big success. We had 500 funds applying and 20 went through the program that finished last year. And actually, we'll be looking to bring on the next cohort over the next few months as well. So I spend a lot of time speaking to LPs, a lot of time speaking to GPs, and fundraising is kind of the area of focus. And then personally, I've got 2 kids and happily married in Surrey, which is about half an hour south of London, for those who know the UK. It's like a good balance of country and city life. That's me.
Amazing. Amazing, Jonathan. Thank you so much. So today, everyone, we're battling it out is basically what we're doing. Okay. I also wore my red, white, and I have my blue background because I'll be representing the US. I'm also going to be doing a lot of this. Give me a second. There we go. Yeah, and then Jonathan, you can do the same with your European flag. Okay, so everyone here, we want you to be involved as well. We're here to debate, we're here to kind of examine, be curious, right? And untangle kind of the differences and the similarities as well between these two leading regions in venture capital. So we're going to dive right into our first question, which is what is the profile of managers who tend to start VC funds in your market. And Jonathan, we can kind of alternate who goes first. I feel like I've been speaking a lot, so maybe you can go first for this one.
Yeah, sure. Maybe this is also one that hasn't got too many similarities, but I don't know. Maybe we'll find too many differences, but maybe we'll find some. So I guess we're speaking from a position of I know we called it EU, but I guess we're more widely given that we've left Europe plus UK, and it's very much a small specialist fund. So there's always an argument on specialist for agnostics. So generally, profile of emerging is more on the specialist side, quite a small fund size, often spin outs from established managers. If I look at some of the data we had out of the 500 funds that applied, maybe a fifth were specific spin outs from existing legacy or established brands. Um, and then also angels, but not just angels, angels with a community. So people that have done some tickets, but actually have also built out a community of followers, either in a specific sector or a specific geography. So a lot of accelerators, incubator type models or angel networks that want to professionalize. I've been doing investing for a long time, and then now I'd like to invest someone else's money. God knows why they make that choice, but many do. And then also operators and ex-founders who actually tend to raise quite quickly. There's been a few of those in Europe, some really good success stories and we've also got some that are actually current operators that are also emerging managers, which, I'm not sure if they've got any time to do anything else apart from both those roles. But those are the selection. So quite a few operators, a lot of angel community people, and also, kind of spin outs.
Yeah. So I think a lot of similarities with what kind of the profiles we tended to see from US managers launching funds in the US. So here's the kind of main characteristics that we were seeing. And I'm looking at this from the perspective as well of who was successful at raising the fund on in general, right? So, one characteristic that we would see in successful US fund managers were people who were actually very well connected. So, whether that's very well connected among startup founders, which is kind of a given if you're, going to be launching a VC firm, you're probably really well connected to founders. I'm going to come back to that. But the other kind of side of the coin is also being really well connected to limited partners, right? And so we would see that successful US managers would launch a fund and they'd usually kind of have some sort of background that meant that either they kind of had made a lot of money being very successful in a previous career or venture that they were doing, or they just kind of like came from a wealthy kind of network for whatever reason. And this really helps when you kind of start pitching to LPs. And again, we're going to come back and talk about that at length later. We would see that the successful GPs were those that have some sort of an edge, right? So that makes them be successful in whatever thesis they're launching the fund around. So usually that could mean they have a successful investment track record as an angel investor, mainly. So they would invest their own money within kind of the thesis that they're launching the fund around, and they've seen some good returns. Or they have a unique access to differentiated deal flow that other VCs are not seeing because maybe it's deal flow that comes from a community that they built or a school that they're teaching at or a religious group that they're a part of. There's, fund managers that are launching funds, investing in founders from their own religious groups. Or, there's all sorts of kind of flavors. Or it would be individuals who have some sort of very strong advisory or operational track record. So it would be people that have mentored startups and helped to grow the value and valuation of startups through mentoring, sitting on boards, and stuff like that. What we tended not to see working well was individuals who came into venture capital, wanted to launch a fund, and had like an M&A or investment banking type of background. And I know these kind of profiles, they are more successful launching funds in Europe. I was working at a fund where the managing partner and the founding partner was an investment banker. But in the US, it doesn't really work well. Limited partners don't really see how your experience as being an investment banker really translate to you being a good VC. And also, the other thing that didn't work a lot was just people that came from a specific industry. If they didn't have access to startups in that space, by virtue of being in that industry and putting themselves out there as someone who is an expert in a certain sector, but is also kind of connected to founders building in that sector and can support them and stuff like that. So, yeah, that's kind of what we were seeing in the US. All right. Let's move on to this next one. So, what are typical fund sizes that are viable and strategic for a fund one in these two markets? So, I'll start with the US. Gonna wave my flags again. So, what are typical fund sizes for a fund one in these two geographies? So, I would say in the US, it's on average a $10 million fund for fund one. So, this is large enough that you can put together a portfolio with enough shots on goal. So it gives you that diversification, but it's large enough that you can have meaningful ownership within each of these portfolio companies to generate good returns for your limited partners. So the strategy in the US is very much do a small fund one, deploy that quickly, get markups fast, and then go back out to market to raise a fund two, which is going to be slightly larger, deploy that, get markups, go back out to market and raise a slightly larger fund three, right? And so on and so forth until you start kind of stacking up the funds, therefore the management fees, and it starts kind of becoming a business where you can sustain yourself with the management fees alone. But in the first kind of few funds, it's very much carry based. A lot of people take pay cuts to do the fund, or they don't pay themselves at all to kind of do launch the VC firm because the funds, the initial funds are very small. Jonathan?
Yes, I think there's probably less of a focus on the subsequent funds and the speed. I think it takes quite a bit of time. So I think the advice is less get something out, get loads of TDPI or markups, and then go back. I think it's a much slower process to raise, and it's a much slower process to raise your second. I think most who are raising their first aren't thinking so much about their second, although they're building relationships with LPs. I think a typical fund size is, in the 5 to 20 region. Maybe in the 5 to 50 broadly, and 5 to 20 if you were kind of narrowing it down. If you're investing half a mil a ticket, 50 mil doesn't really work. And so if your construction is just too large a fund, it's also much harder to raise. There's obviously an inverse, I say obviously, there is an inverse correlation on when you reach a certain fund size, the speed and relative easiness of raising. And so you can raise often a faster couple 100 mil fund because a lot of the institutions open up, because often institutions are looking at minimum 10 mil and maximum of 10% allocation. And so often in Europe, if you're raising anything less than 100, many institutions aren't within your target LP bucket. And so often if you're raising a few hundred, it's easier than if you're raising 10 or 20. We've had a few, actually, we had today, there was a fund one that just launched this morning, actually. Rick, one of the ex-investors, one of Speed Invest deep tech funds, just launched this morning online. I think they raised a 50 mil fund. I think that's quite rare for a first-time fund. But I'd say most are in the 10 to 20 range. Interesting, I've just come back from Southeast Asia last week. We launched a pilot program of our GP accelerator out there, and there the fund size was 5 to 10 was average for fund one. And so interesting that, and the reason I mentioned them now is, looking at other processes and other LPs, actually, that's probably one of the main differences we see in Southeast Asia versus Europe. It's even smaller there. We also see a lot of fund sizes changing, which, I think, as you can imagine, when you're investing in companies and founders, that their total round size also changes. That's fairly common in Europe. And LPs talk. There's lots of WhatsApp groups I'm involved in, and everyone's slating each other and slating their VCs who, oh, I thought they were raising 20, or then they're raising 5, or they're going to first close at 1. Where the hell is the number? So just be very cognizant of that. Things get shared quite openly on groups and discussed behind your back.
Very wise advice. Next up, we have how much skin in the game do LPs expect to see from the general partner? So in the US, it would typically be 1% of the fund size in cash into the fund or in deal warehousing. So, deal warehousing is where the GP may have made a personal angel investment in a startup. And when they launch the fund, they move that investment at cost into the fund. So that kind of counts as their GP commit. And what it does is that if the startup, and you'd usually do this if the startup has been marked up in most cases, so you would move that startup at cost into the fund, and it means that any upside that the investment has seen since your investment is basically gifted to the limited partners, right? How much skin in the game? So 1% of the fund size in cash or in deal warehouse is kind of what US LPs expect to see. Jonathan?
Yeah, probably more 1 to 2. I think we've seen a lot of 2%, especially in the age of being able to borrow off that. So SVB used to do that a lot, I think, in Europe, and obviously a little bit less so now. But used to be able to get a loan or get some security. I've always said that's quite a neat business model. If any of you want a cool startup idea, this is one. Build a scalable proposition to loan GPs that have signed their LPs on, because as soon as you get the fund off the ground, your income is pretty much guaranteed. And so I think there's quite a big use case to do that for small micro funds, but it does exist at the moment. And if you speak to potential lenders, they're willing to offset and provide you some of the cash. So because of that, then the position and argument is that therefore 2% isn't unreasonable, because it's not that you've got to fork out straight away. Is that you're getting paid that as your first year management fee. And you can do different structures where instead of taking the paying straight away, you pay it over a certain period of time. It also, of course, depends on your net assets and wealth. So, a exited founder should not be worrying too much about putting in 2%. Whereas if it's a first-time fund without the background connections or savings, because often you're especially in Europe, you're going at it for 2 years plus. So you've got to pay for yourself somehow. And so if you're in a difficult position, then it might be lower. But this should never really be a point of a contention point as a deal breaker.
Yeah, amazing. Okay, and yeah, actually, I do want to add there is a trend of there being very, kind of a lot more diverse GPs coming into the market and starting their own funds. And to your point, Jonathan, it's not always possible. There's a lot of kind of GPs that come from underrepresented backgrounds or not very wealthy kind of like circles and stuff like that. And so, yeah, I think for some thesis statements and for some GPs, it's fine if you're not going to commit to the fund. I can tell that you're super committed because XYZ, so yeah, not absolutely. It's not a deal breaker if you don't have it. Okay, so Jonathan, I'll let you go first on this one. So once someone decides that they're doing this and they're launching the fund, what are the first steps to get started?
Well, I guess that the first step shouldn't really necessarily be looking at the compliance and the legal bits, which I think some people do. The first steps is probably coming up with a reasonable thesis and a differentiated product, a differentiated solution, something that not the other thousand or so funds have got in their mandate. I think you'll probably all recall, there's been cycles. It used to be fintech, and then it went into, especially in Europe, kind of climate. Then that morphed into sustainability, and then deep tech about a year and a bit ago, and then now AI. And you've got these sectors that have come and gone, and then prop tech came and went as well over the last decade. And so these sectors have come and gone, and so I think it's important to build a thesis that is differentiated against the crowd. And that's probably a large part of the work you need to do at the start before even thinking about all of the operational aspect. And then, of course, once you've got that, socializing the idea with friends and with people in the space that might be able to support you in it. But the thesis and differentiation is critical. And then what leads from that is the LP proposition. You've got what you're looking to do, but how actually you might fit into an LP's mandate and an investor's an investor's mandate. And my advice there is to do a lot of self-review and self-critique. And I think GPs often don't do enough reflection on that and consider why a founder would choose you in the cap table instead of one of the brand names, and B, why an LP would choose you instead of the other thousands of funds they speak to. And I think nailing those questions down is probably the first step. And the best way of thinking about that is elevators. If someone asks you what you're looking to invest in, having a very short and sharp answer to that. And actually, we ran a session during one of the workshops last year, and it was rare that even the VCs in the room knew exactly what you were doing. And the way you did that is someone stands in front of the classroom and tells 20 funds, this is who I am, and this is what I invest in, and this is my differentiator. And then if you then ask the group, put your hand up who understood their differentiator, and half the group have no idea, don't put their hand up or have got no idea what their USP is, you should probably go back and consider exactly what it is and why you're looking to launch. So it's a bit more of a kind of deeper dive on the thesis point, but we've seen it time and time again that not having a very clear mandate, both from founders and from LPs, is even impacting later stage funds. So that would be my bit of advice.
Yeah, yeah, no, really good. So similar thing in the US. So you start out with the thesis and spend a lot of time to align the thesis with the unique edge and secret sauce and unfair advantage that the GP has. So even if the thesis was a little bit more general, it was just AI or something that a lot of VCs are playing in, we would spend a lot of time to be like, okay, but why are you better? Why are you better positioned to generate outsized returns in this space particularly? So the thesis work is very much, yeah, let's align your unique edge as a GP to what it is that your fund is going to be investing in. And as part of the thesis definition, it wasn't just stage, sector, geography of where your investments are going to be. It is also why you and what's your secret sauce, you know? So that whole kind of thing, whole equation constituted the thesis for us. So that's step one. And the idea here is that your thesis would be evolving with time, but at least you want to get it to a really good kind of baseline level. Then, as soon as possible, you want to start talking to limited partners who would start out being kind of like your close friends, family, first degree network. You iterate on your thesis and then you start getting initial commitments straight away. So you want to see straight off the get-go if you're going to be getting people excited about the fund that you're launching because you're pitching them your thesis, you're going out there, talking about what you're doing. And the idea is in the US and that a lot of people will just be, hey, like, hey, I want to be involved in this. And this is kind of like where I saw a lot of the EU managers coming by being like, that doesn't work this way in Europe. So yeah, so you get initial commitments, and that's before you put your deck together, your financial projections, your data room, before you kind of decide who your vendors are going to be and all of that. And if you can't get those initial commitments, and it's kind of like you might as well not do the fund to begin with. You don't have enough traction and validation in the market that what you're building is something limited partners want to invest in.
Yes, I think in Europe it probably takes a bit longer, and I think you're not normally fundraising before the debt before a proper well thought out thesis. But then on the inverse, you also because of the laws and regulations, you also want to not be fundraising as when you're fundraising. So because of the way that regulations are structured, if you go out with the deck saying you're fundraising, you then need to be regulated. So the best way of fundraising is not to say you're fundraising, it's actually to build relationships and to have conversations around sectors and specialists and what they see in the market, and then just so happen to have an interesting product if they're interested. but there's a lot of red tape, and I guess we can come on to that. But one of the questions is around ease of raising in Europe versus the States, and there is a lot more regulation, of course. That's what we're known for in Europe. One of the many things, I guess, and that's absolutely true in the venture space. And so there's all sorts of things to consider when you're raising a fund, especially when you're posting on LinkedIn. We're not going to go down the avenue of what you can and can't do, but the best thing to do is to speak to lawyers about what you can do. What you can't say online is that you're raising without being regulated and come and invest. That is absolutely not allowed. And so you'll often not see those kind of statements. The statements that you will see online are much more around, we're organizing an event around this particular area, we're going to be there, or we're considering thinking about the market, which therefore might be more similarity on the state of getting some commitment early. But you definitely need to have, a lot of things prepared before having those conversations.
Amazing, amazing. So, how long does it realistically take from the decision to launch a fund to a first close? So the fastest we had seen was 3 months to get to a first close. But I would say on average for the ones that managed to get to a first close, maybe 8 months. Some did it in 6 months, some it took a lot longer. But yeah, fastest is three, and average I would say is eight.
In Europe, fastest is also three, and standard is probably 18.
Yeah, yeah. Who are the primary limited partners and limited partner targets for a fund one in these markets? So, for a fund one in the US, it would be exclusively high net worth individuals that are first degree or second degree connected to the GPs raising the fund. No institutional investors, very little government funding, depending on kind of where you are in the States. Otherwise, it's all private capital.
And in Europe, it's almost certainly going to be a government anchor, and then the other LPs will be high net worth individuals and family offices, and then probably one or two funder funds who are hyper focused, although they've been struggling to raise for the last 24 months. So they used to be incredibly active, especially when we did our report 2 years ago. There were 100 and most of them were investing. Since then, of course, they've been struggling to raise, which is a word of optimism for this group because if founders have it tough, VCs have it tougher, and funder funds have it nearly impossible. So whenever you meet a fund of funds looking to invest in you, you should, first and foremost congratulate them and ask them how the hell they managed to raise this vehicle of theirs, because the pool of capital as you go up the value chain shrinks to practically nothing. And so for fund one specifically, it's a real struggle because the only LP group they're able to speak is high net worth. And so government, I'm sure people were laughing about that, but remains the center of all European VC. And in Greece, actually, where one of us is located, there are some VCs with 100% government money, believe it.
No, 80%,
A
80%.
hundred, 100. Which one are you thinking about?
Many.
I've got one in mind. I've got one in mind that's 100.
Okay, I need to fact check that. That
Okay,
should not
I'll
be.
mention it to you offline. Yeah, well, it's
And
not the same party, right? It's a European government. It's a Greek local.
oh, yeah, yeah, yeah. Okay, so mix of government LPs.
Yeah, it's a mix of government. It's still government.
Yeah, yeah, yeah. Okay, yeah. No, in Greece, I think it's almost every single fund has raised government funding. There are a few now. There's one that isn't, but he's not investing in Greece. And I think there's like some new ones that are coming into the market with no government funding. And when I say government funding, it's specifically EIF capital, just EIF. And then the rest would be limited partners that are private. Okay, so micro VCs and pilot funds tend to be smaller in Europe and larger in the US overall. So I can address that. I've seen the opposite in the US now. There's kind of like nano funds, not just micro, like super, super small funds, less than $1 million coming up because it's becoming cheaper and cheaper to launch a fund. I will say though that those are funds. They're not kind of like VC firms that are set up this way. It's funds that will then be moved into a larger proper firm structure for a fund two, etc. But that is this kind of like innovation is dropping the cost of doing a pilot fund. You can have one that's super small.
But I think there's a probably exceptions in the sense that they're not really your traditional, looking to build an enduring franchise of with staff and stuff. It's probably more people with side hustles, as opposed to I think in Europe you have less of those because the cost is higher. So you can't really jump on a tech solution and pay nothing and get something together. So I think that there's probably an interesting data point where the US has got a lot smaller, then it jumps up, and then Europe kind of um, stays at a certain minimum level.
Yeah. What's the minimum in Europe, Jonathan, for like a proper firm structure?
Probably around 5 to 10.
5 to
But
10.
you'd have to be doing, that it'd be a struggle, especially with the costs involved. But if you've got less than five, you wouldn't normally go out and say you've raised a VC fund because it's probably a bit too small to LinkedIn have a LinkedIn flex on. I don't know if Americans are flexing their 1 million fund on LinkedIn saying, I've just spent 2 years and I've got this 1 mil fund out.
I haven't seen a $1 million fund being flexed, but I recently saw like a $2.3 million fund being flexed. There's a large splash about it too.
Oh, really? Nice.
Yeah.
Was it like a specific community?
Yeah. Yeah. And kind of also investing in underrepresented founders too.
Yeah. Yeah, well, I think if there's a specific angle to it, I think but if it's, your standard Series A or standard seed, AI fund without much focus, it's probably unlikely to.
Well, since we're talking about kind of the minimum fund size, I think we should talk about formation and operating costs because that kind of the formation and operating costs define in each of these territories what's the minimum fund size that you can have generally, right? Because you need to make the economics make sense. So when you raise your fund one, you're going to take out whatever fund admin, fund formation out of the fund, and then you're going to be left with something that's quite small to invest. And you need to make sure that's enough to kind of make enough investments, have enough ownership in these investments, and so on and so forth. So, Jonathan, do you want to tell us in Europe what it costs to form and operate a fund?
Yeah, yes. If you speak to a standard fund admin, kind of generic, and you ask them, what's a reasonable position, you're looking at 100 grand for a standard fund admin. For a law firm, it might be 50, 60. And then you've got the accountants, the audit, the compliance, the regs. So for a typical fund is 2 to 300K. If you're looking to cut costs and looking for a pure tech solution where there's no people involved, and there's plenty of those now, you can probably get something in the 50 to 100K mark. But that's where you're kind of scraping the barrel, getting a few deals, benefiting from the discounts, and going for a much more tech-enabled solution as opposed to someone you can pick up the phone to. But the majority of fund admins, I'd say around that level, and as our lawyers, where you can go cheaper, there might be some law firms that say, "Oh, we're looking to build the relationship. We might take a bit of a hit on year one because we really like you, and you're whatever X, Y, Z." And so you much like when you're raising from LPs, you can also position a slight discount or a slight preference for service providers who might then take a view, and you might end up with a mainstream service provider, which adds more credibility to LPs, but can do it for a slightly cost-effective way. Or, as I said, you go for a very tech-enabled operational model where it's, an audit a very cheap audit, kind of a high street law firm that doesn't quite understand VC or that super tech enabled. So, and I think that's changing rapidly. There's a bit of a debate going on among some of the technology providers. Should it all be tech? Should it all be automated? We haven't really arrived at a conclusion, and that's mostly because of the complexity of regulations.
Yeah, and then in the US, to form a proper VC fund, it would be between 30K and 60K to get the firm and the fund going. And then to operate, this depends, but I think you could maybe start at like 20 to 30K if your fund is very small. And then if you have kind of something like a start fund or some sort of vehicle that's not exactly a VC firm, then the costs go down drastically to almost none, to be honest. So yeah, that's kind of what we see. And then all of it is tends to be outsourced in the US to very specialized service providers that kind of specialize in venture capital. And this kind of tends to be true for fund formation all the way to fund ops. And the kind of fund admin providers are taking more and more of like a holistic approach of what they do and how they service VC funds to be able to be like a one-stop shop. You don't need any other provider plugged in to be running the firm. So yeah, I guess it's kind of really being simplified in the US from that perspective.
So quite a big cost difference between the two.
Yeah, and there's no mandatory audits in the US as well. So that's an additional cost that a US fund would not need to account for.
And then thought on a GP seeder, an LP that also has a part of the management. That's becoming quite common. And actually, that's a model we stayed well clear from the program we launched. It had no economics either going in or going out. But there are a lot of players now that do have a preference on that. That's seen with mixed outcomes from LPs,
Hmm.
taking a stake where there's no strategic value, or giving away economics is seen often on balance, it's never seen positively, and it may be seen negatively. Um, Unless, of course, you have the Koreans or Japanese knocking on your door if you're in Europe, and they provide a whole chunk of capital for half your banco. And so that we've seen instances of that.
Hmm.
And so there it's, euros. You don't have to spend 2 years, listening to these webinars. You can just accept the money and give them 50% of your control. And some GPs decide to do that because well, it saves them 2 years of hell. And also it provides a high probability of executing on the deals. And so a lot of the sovereign wealth funds in Asia are coming in and doing that with European GPs. So that's one area. And then the other area is, if you're raising a 10 mil and someone comes in with a 2 mil ticket, there's a few organizations that now provide the 2 mil, anchor your fund, get you to do the fund admin specifically and force you to use their products, which is, fine if that's the way you want to go. And then also take 10 to 20% of the upside. And again, you need to make the call. Is the value add and anchor worth the negative signal? Or would you rather keep it clean and go ahead, which is the exact same decision founders often use when they're speaking to VCs. Do I take this ridiculous preference stack that I'm not going to see a dime in 10 years? Or do I say no? And often, if you've got no other interested parties, you need to make a decision whether you take it. And so the answer to that is always the competitive tensions and how many other parties might be interested. But as a general rule, giving away stuff that you own is obviously not a good thing, and unless you have a specific requirement.
And the thing you need to consider if you're going to be putting someone in your management company is that this individual or organization, they're gonna own parts of every single fund that you're gonna launch subsequently. So they're not just there for fund one, they'll be there until however long you're gonna be launching funds for. And so, yeah, they might help you at the beginning, but are they really gonna be adding value at a fund two and a fund three and beyond? Probably not. So, yeah, really agree with Jonathan's kind of recommendation to try and steer away from that. If you can raise without this type of funder in your fund, then definitely do it. I perceive EU LPs to be far more risk averse, conservative, and slow to decide. Thoughts?
I guess the benefit is they're more funder funds. But I've seen quite a few actually in the States. Passive Ventures one, I've seen quite a few that have launched. But generally we have more funder funds here, and therefore they speak VC. And of course, their job is to speak to you. And that's the biggest issue in raising a VC funds, as I'm sure you all know. When you're a founder, you speak to people that are paid to speak to you. When you're a VC, you speak to people that are not paid to speak to you. And the exception to that is government funder funds. And as a result of that, funder funds are a very active part of the community because they speak and learn, they know the language. And of course, as I mentioned, they fundraise themselves. So that's the benefit, I think, of Europe when they are active and when the market is up. Fingers crossed with these two IPOs coming up, they'll throw back capital into the system. Then we've got quite good numbers of investors that are willing to back emerging managers. And their value prop to their LPs is, we find and hunt the best emerging VCs, so you don't have to. So I think that's the positive for a fund one. The negative is anything else. I think we fall way behind endowment institutions, pension funds, you name it. Unless actually you are from Iceland. Now, Iceland, like Greece, is a good example because we've got in Greece obviously this fund that's 100% government, but in Iceland we have pension funds and pension funds in the Nordics, which covers north eastern part of Europe, are very active in Iceland. We'll play a game. Who can tell me what the lowest LP percentage? What do you all think the lowest LP percentage from pension funds in on average in Iceland, and what's the highest? I.e., 10% would mean that the average LP composition in Iceland from pensions is 10. Any other takers? Lowest 50, oh, very good. 30 to 40, 5 to 25. Nice. Okay, well, the answer is 69% to 100%. So there is a VC that's got 100% pension money. When I asked them how the hell they got that, they said that well, they got one. When they got one, they got all of them. And the lowest around the 69, 70% mark is also pretty insane. There's about 25 funds there, and it's a small country, 300,000 or so in the capital. But it's a pretty nice use case of pension money going in to a fairly risky asset class. Pension fund contributions in the UK is more like 1%. And we've been doing a lot to try and get more in. And then Germany and the DACH region is probably more like 3, 4%. And many actually pension funds from the Nordics come into UK funds, as do pension funds in the States. And this is a constant bugbear for a lot of the UK ecosystem. In Parliament, there's all these discussions that happen, and you can imagine the PM and other ministers going, why on earth is 1% of pension funds coming into UK VC, but the states come in at 5, 6%, and no one can get their head around why people from outside the UK and outside Europe are coming in via the pension and investing in European venture. And I think people know that, and they're trying to change it to try and increase the education of that. I'm not sure how we got to talking about,
So,
but
yeah, and I will say that the Nordic European countries were one of the first, and specifically the pension funds were some of the first institutional type of investors to be investing in emerging VCs. And a previous colleague of mine was kind of like a pioneer of that movement. He was working at a pension fund and kind of started the program that invests in emerging VCs, and it actually became really successful. So there is kind of a history and a culture of doing that, and I love that you brought up the use case in Iceland. So, Jonathan, do those pension fund stats refer to limited partners investing into their own geographies, or do you see pension funds from EU committing to UK based and UK focused funds?
the 70 to 100 broadly was Iceland pensions investing in Iceland VCs, although the Nordic is slightly different where they often treat the Nordic as a block. So it wasn't pension funds in Iceland going into UK funds, although we are also pushing that. And actually one of my friends runs the Icelandic fund of fund team, and he's been pushing that for a few years. So the stats I quoted were just Iceland. And then the EU fund, the European pension funds are investing into UK, but that's because UK is, one of the hubs of tech and venture in Europe, and also a lot of UK funds invest into Europe. Generally, the position with government is very clear and very obvious. They're there for market failure, and they're there to support their own domestic economy. And so the reason why we have the IFKW and all these other acronyms investing all over the place is because the VCs they invest into are investing all over the place. If a German or if a Greek LP was investing in a Greek VC, then the expectation is that at least 1 to 2x of the amount they invest in goes into Greece, and that's the case across Europe. And there's many GPs that have a little sprinkling from Belgium government, UK government, and then all of a sudden you've got your whole LP stack. And so that you can imagine the agreements are slightly precarious because one of them says invest here, another one says invest there, and you kind of have to work out the mechanics. But generally, that's the position. If you're getting government funding, it's because you're supporting the local economy. And if you're based there and investing elsewhere, that's fine, as long as the money that you're getting is going into that one.
Amazing. And then very quickly, and then we need to wrap, Jonathan. So, which EU countries are the most popular domiciles for EU funds?
It's not so much so it's not about where you're based, it's more about where you're theoretically domiciled. And the most common are Guernsey and Jersey, which are the Channel Islands. And then the other common one is Luxembourg. So those are the two common jurisdictions. But you don't have to necessarily live there.
Amazing. Jonathan, I do want to wrap up this event, first of all, by saying thank you for being here and, joining this kind of conversation. But second of all, can you tell everyone here about your program for emerging GPs? Because I hear your applications are open for the next cohort.
Yes, they remain open because I'm busy fundraising myself for some sponsorship, which is as much of a nightmare as you can imagine is raising a fund. Because the way that we structured the program is completely free for the applicants. And so if you join and if you apply, there's no hidden costs at all throughout. And as a result of that, I spend a lot of time with potential sponsors to then fund the program so then they can meet the GPs on it and it can be free to participate. So that's the position at the moment. So we're currently finalizing what that looks like and expect to launch the program after the summer this year. And it's for investors that are specifically investing in Europe and who can come along and engage in the workshops based in London. And broadly, it falls into three buckets. First one is workshops with all the best established managers telling you how to build your franchises. So, for example, Robin Klein, who's a founder of Local Globe, is now on 20 billion AUM, built it from scratch. Now his son is also involved. He comes in, tells you how he did it. There's a lot of interesting insight shared. So the first one is workshops led by us and experts. The second one is LP connections. So we organize 20 odd events all over Europe, bring on the local LP system alongside the cohort, a bit like a roadshow, like you would do if you were fundraising. And then the third one is we share best practice, resources, and mentors to the participants. And the goal ultimately is to make Europe a better place to build and scale a VC fund.
Amazing. Wonderful. Jonathan, thank you again so much for being here. And
And thank you for hosting, and thanks everyone for joining. Drop me a note if you want to chat further.
all right, everyone. Have a great
Bye.
one. Bye.